From the world of politics to the world of business, this is Balance of Power with David Weston.
From Bloomberg World Headquarters in New York to our television and radio audiences worldwide, welcome to Balance of Power. It's Friday, and it's been quite a week for monetary policymakers, from the United States to the Fed to really central banks around the world raising rates, including, of course, in the United Kingdom. The question now is, what is the aftermath of all these policy moves? And to start to answer that question, we welcome now Michael McKee. He's Bloomberg International Economics and Policy Correspondent. So we could go right around the world, Mike, but let's start with the United States.
You could, as they said, from Ulaanbaatar
exactly.
all the way to Washington. There have been an enormous number of banks raising rates. And it's not just raising rates in the normal sense that we think about 25 basis points at a time here and there. These have been big moves among all of these central banks, 50 and 75 basis points, the Swiss going up 75 and getting out of negative rates. It's been quite a change. And for the United States, obviously, a move by the Fed that has everybody wondering what comes next. 75 basis points plus, they say another 125 coming in this year. And that means more unemployment in the United States. Jay Powell making the case that, yes, we probably are going to have well, he didn't use the word recession, but he talked about having a 4.4% unemployment rate, which would translate to about 1.5 million jobs. And we've never seen that much of a change in the unemployment rate without having a recession. So the U.S. heading maybe into recession, just a question of when. And then, of course, you've got the British. They only went 50 basis points, but now markets are betting that the Bank of England will have to go between 75 and 100 because the new prime minister has announced her new mini budget, her way of stimulating an economy that may already be in recession. Liz Truss wants to cut taxes on the richest Britons, cap energy price payments, set a 2.5% trend growth goal, create investment zones, and then, just to make everybody happy, cancel the rise in alcohol duties. Now, a lot of economists think none of this is going to work, that trickle-down economics isn't going to help in this case. Energy price payments would be good for most people, but that would also perhaps lead to some additional inflation. And then the 2.5% growth goal for trend growth, there aren't many people who think they can do that. So it's going to be pretty tough, and that's why we've seen this huge drop in the pound today. And some people wondering if this is going to end up something like a currency crisis that we saw in the 1990s.
It may prove that the wisest part of all that, Mike, is the cut in the duties on alcohol. They may need it.
Yes, they may need it. Well, a lot of pubs have been going out of business, they say.
Okay, thanks so much to Bloomberg's Michael McKee. Now we want to get the view of an economist, Glenn Hubbard, Columbia Business School professor and dean emeritus. Dr. Hubbard served as chair of the Council of Economic Advisors under President George W. Bush. So, Glenn, thank you so much for being with us. I guess I'm really thinking about après le deluge. I mean, okay, we've had all these policy moves now. The question is, what should we expect happens next? We're going to find out. Start in the United States. How bad is it? Is the sky falling?
Well, I don't know that the sky is falling, but clearly markets are waking up. I mean, what the Fed just did was a continuation of the remarks that Chair Powell gave in Jackson Hole about really getting the message of needing a firmer monetary policy. The shift in the projections from a few months ago to now is really chilling. It means the Fed really does realize that a higher and higher for longer Fed funds rate is needed. I think the probability of a recession is much, much higher for 2023. And I think the Fed has now understood that and the markets have understood that. And so the pain is continuing.
So talk about the pain a little bit, Glenn, insofar as we can project, and it's difficult to do that. Where is some of that pain going to be felt? Unemployment, certainly, Mike McKee just mentioned that. Housing, we're starting to see in the United States. Where should we see it show up in the economy?
Well, what we're seeing is where you might expect. So housing, because it's a very interest-sensitive sector, the high mortgage rates are clearly working as they should. The stock market fall is reflecting higher discount rates and risk. And soon we'll probably see pockets of risk in the bond market start to reappear as investors reevaluate credit risk. It will take a significant increase in unemployment to really bring inflation all the way down to 2. In a sense, the Fed has two challenges, going from the very high level down to, say, 4, like getting through supply disruptions, supply chain issues. and then getting all the way down to 2. The question is how quickly to do that. Doing that quickly would require substantial unemployment.
And I'm not sure if history is any guide here, but I think if we look at history, it's not that easy to get down to 2% once you're over 5.
It's not. You can do it. We have done it in the United States. It takes time. And so the question is how gradual the Fed intends to be. The bond market seems to believe we will get back to 2% inflation in fairly short order. At least the Fed's revised forecasts are admitting some pain in trying to do so.
So let's talk about United Kingdom, because we did have that budget out today. It caught a lot of people's attention, particularly bond traders. If you look at what happened to gilts, it's pretty extraordinary. Whatever the rise in rates was here, it's nothing compared to what we're seeing right now in the United Kingdom. What do you make about the economic policy here? Because we have some outside advisors to Liz Truss, the Prime Minister, saying, cutting taxes actually doesn't contribute to inflation.
Well, I wouldn't go that quickly on that point. I think that it's great to set an aspirational growth target, but the UK has a productivity problem. And in the near term, there is a need to cap energy costs, but it could be for lower income people. You don't really need such a large scale transfer. So I do think there's a big risk of inflation from the UK policy. And I think a more narrow policy and then coupled with a more medium run agenda on productivity would have been more what the doctor ordered.
So, Glenn, finally, give us a sense of how these things interact with one another. As we said, there's something like 700 basis points in increased interest rates this week from central banks around the world. So everybody seems to be tightening, with the exception of Japan, mind you. But what does this do in terms of the global growth and the prospects for the global economy? How does it interrelated?
Well, it's interrelated, I think, in 2 respects. One, the raising of interest rates through much of the world will have a reduced effect on growth. It's also showing up in markets for commodities, for minerals, for agricultural products, which affects many nations around the world. Second, there's an issue of the Fed's policy error and then recorrection that we're now seeing spilling over into the rest of the world. The rest of the world is caught up in a dynamic that may have had its origins elsewhere. Even here at home, we're likely to see interactions and interrelationships with politics as inflation falls, but recession fears loom.
And I don't think we can have this conversation, can't conclude it without talking about currency and what is going on with the dollar, setting yet new records around the world. We saw Japan actually start to try to intervene on behalf of the yen. Doesn't seem to be working much. What do you make of the stronger dollar? Does that have to be contained?
Well, the strong dollar is good on one side of the equation, of course, if you're buying something from overseas, but it really is hurting many American firms and sectors. The real issue is having the dollar reflect fundamental values in the United States and to make sure that monetary policy and fiscal policies are more coordinated around the world. We're just starting to have that conversation.
Well, let's talk about the coordination just for one moment. This week yesterday marked the 37th anniversary of the Plaza Accord on the dollar. Any prospect of that kind of coordinated intervention with currencies?
I doubt it, but I do think there's going to have to be a discussion at the G20 level of what kinds of fiscal policies and monetary policies work in this environment. And I expect the U.S. to get some rebuke from some nations about the roller coaster we've been on in fiscal policy and monetary policy.
Glenn, it's always great to have you on, particularly on a week like this week. That's Glenn Hubbard of the Columbia Business School. Coming up, Britain comes out with a budget as Italy heads to elections on Sunday. We're going to go through what all this means for the economy and the markets with Jacob Kierkegaard of the Peterson Institute. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David West, and to keep you up to date with news from all around the world, we turn now to Mark Crumpton here with the first word.
David, thank you so much. In the UK, Liz Truss's government has come out with the most radical set of tax cuts since 1972. Both workers and companies will see their taxes reduced. The basic tax rate will be cut, and the top rate, the richest earners pay, will be abolished.
From April the 23rd, we will have a single higher rate of income tax of 40%. We will cut the basic rate of income tax to 19 pence in April 2023, 1 year early. That means a tax cut for over 31 million people in just a few months' time.
Kwasi Kwarteng also eased the stamp duty on home purchases. That's likely to help home builders and 200,000 buyers a year. And he lifted the cap on bankers' bonuses. U.S. House Republican leader Kevin McCarthy unveiled an agenda today for action on multiple fronts, including the economy, crime, and religious freedom. The issues also serve as a rallying point for GOP candidates in the upcoming midterms. Republicans are expected to win control of the House in November, and McCarthy is in a position to replace Nancy Pelosi as Speaker. After lashing Bermuda, Hurricane Fiona is racing north toward eastern Canada, and it's threatening to become the most powerful storm ever to hit the region. Fiona is on pace to hit Nova Scotia Saturday as a Category 2 hurricane, expected to leave a swath of destruction. Meantime, a second system is developing in the Caribbean and may strike Cuba and Florida early next week. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thank you so much, Mark. Well, major developments in Europe, both today and on Sunday, could have far-reaching consequences for the economies there as well as for markets. To take us through what is going on in the United Kingdom and also on Sunday in Italy, we welcome now Jacob Kierkegaard. He is Senior Fellow at the Peterson Institute for International Economics. Jacob, thanks so much for being with us. Let's start with the United Kingdom. There was the budget announced today, with really a lot of fiscal stimulus coming into an economy that already is pretty stimulated. We talked earlier today with Larry Summers, the former Treasury Secretary, and this is what he had to say about what he thought Britain was doing.
I think the UK is behaving a bit like an emerging market turning itself into a submerging market. It would not surprise me if the pound eventually gets below $1 if the current policy path is maintained.
Jacob, those are pretty sobering words from the former Treasury Secretary. Do you think he's exaggerating, or do you think it's that bad potentially?
No, I think he's right. I mean, I think we have a near total disconnect between where fiscal policy is going, which is obviously massively stimulating, and where monetary policy should be going in the UK, because you've got inflation at about 10%. So something's got to give. So to speak. And if you look at the markets today, clearly it's thumbs down to the long-term sustainability of of the UK government's finances. Yields are up massively. And of course, a dramatic decline also in the pound, reflecting the fact that the UK also has a very large current account or external deficit to cover.
So, Jacob, you've followed these things for years in a way that I have not. Back in the United States, we had something called bond vigilantes back in the 90s that sort of corrected to some extent the government's activity. Certainly, it looked like the people who are trading in gilts today are a bit of a vigilante. Could they correct what's going on? I mean, will the British government listen to the bond yields?
Well, I think you can get to a situation where they'll have to. Or maybe the Bank of England is going to have an emergency meeting and raise rates further. Of course, that would make further government deficits even more expensive. So, as I said, you have a fundamental macroeconomic clash between fiscal and monetary policy in the UK at the moment. And, where we're going, one of the two has got to give. But given that we have a new government that has just come into power, and this is their basically signature policies, it's difficult for me to see them do a U-turn in the short run, which suggests that you could have this situation of the government trying to give tax cuts, but the central bank basically, in the eyes of the consumer, taking it all away again through rising interest rates.
So, Jacob, that, of course, all comes on the heels of Brexit. A lot of economists think that makes it even harder for the British government at this point. Let's go to a country very much inside the European Union, and that is Italy, that's having their elections on Sunday, with most people saying they think that the substantially right-of-center coalition, as I understand it, led by the Brothers of Italy, will prevail. If they do, what will that mean?
Well, I mean, it would certainly mean the end of the political career, first of all, of Mario Draghi as caretaker prime minister, which, everything else being equal, I think will lower the influence of Italy in the EU and indeed actually on the global stage, because Meloni will not have the stature of Mario Draghi. On fiscal issues and macroeconomics, I actually don't expect there to be major changes because this is a center-right government. Several of the other parties have a history of relative conservative fiscal policies. But perhaps more importantly, right now, if the new government, if you like, sticks to already agreed reform commitments with the EU, they will have access to up to 200 billion euros in EU money that was created in the aftermath of the pandemic. So there is a real carrot here from Meloni to if you like, behave in a macroeconomic sense. But beyond that, I think there's plenty of scope for clashes between this new government and the EU on sanctions, on whether or not Meloni will support Viktor Orban in Hungary, and a whole host of other issues.
Well, on the economic front, some of the things I've read that Ms. Meloni has said have not been particularly warm and friendly toward the European Union, I think it's fair to say. Is she going to have to change her rhetoric here in order to really make sure she has access to what the EU can offer her?
Well, I think it would help if she changed her rhetoric, but I certainly think what she doesn't, or what she will not be able to do, is to change many of the reform commitments that Mario Draghi's government has entered into while in government. So she's going to have to essentially continue many of Mario Draghi's macroeconomic policies, whatever her rhetoric might be, in order to get that money. So, again, it's a case of something's got to give. But I certainly believe that given the high levels of existing debt in Italy and the, 200 up, maybe almost $200 billion is actually real money for such an Italian government. So I believe that in the end, she will toe the line to these commitments made by the previous government to the EU.
Jacob, give us some sense of the economy that Ms. Meloni, if in fact she does win, what she will be inheriting there, because it looks like growth is down, not too surprising, and the debt may well be up. They've got a lot of challenges before they get to any reform.
Oh, there's no doubt. Italy is a structurally low growth economy. There's no doubt about that. Probably even on the best of days, no more than 1% a year in potential growth rate. It's an economy that's heavily dependent on natural gas, including until recently from Russia. So they have a huge issue in, if you like, bailing out or helping at least Italian consumers and small businesses. And they have to date been quite lavishly doing so with a significant fiscal stimulus to insulate these groups from the rising energy prices. And then, of course, it has Italian debt. It is really, you still, obviously in an era where also the ECB is raising rates quite rapidly, this is a burden for the new government. But as I said, they also have a long list of structural reform agreed and partially implemented by the Draghi government that they are committed or that Italy as a country is committed to fully implementing in order to get access to these EU grants. So this is a government that has, a full plate of economic policies and problems ahead of it. There's no doubt about that.
So, Jason, finally, as you look at the bond market in particular, what is it conveying? Is it conveying sort of your sense that, in fact, even if Ms. Meloni wins, she's going to have to really adjust, trim her sails, as it were, to accommodate the EU? I mean, I see that something like 230 basis point spread between the German bond and the Italian.
Yeah, I mean, I think she is on, the jury is out, so to speak. And I certainly believe that if it turns out that she's jeopardizing these significant fiscal transfers from the EU, you will see spreads rise further. And equally importantly, if she violates the conditionality for those fiscal grants from the EU, she also runs the risk of not being covered or eligible for the new ECB transmission protection instrument, or the sort of, para-helping insurance policy against rising spreads. that was implemented in recent months, which of course could set in motion a potentially very negative spiral for Italian yields. So absolutely, she's on probation.
Okay, on probation. That's well put. Thank you so much, Jacob. Always great having you with us. That's Jacob Kierkegaard. He's Senior Fellow at the Peterson Institute for International Economics. Coming up, we're going to continue to go through the continuing market reaction to the tightening monetary policy in the United States and all around the world, for that matter. This is Balance of Power on Bloomberg Television and on radio.
With a major energy crisis and possible recession looming, Italy heads to the polls. Keep it tuned to Bloomberg for up-to-the-minute results and analysis of what it all means to you. Bloomberg, your global business authority.
This is Balance of Power on Bloomberg Television and Radio. I'm David West, and well, the policymakers have had their say. Now the markets get to say what their reaction is to what we've heard. And to take us through that, we welcome now Kriti Gupta. So there's a lot of reaction out there in the markets today.
A massive reaction. It's on high volume as well, which tells you that the selling is conviction selling, and that's what you're seeing in the S&P 500. It's down 2.3%. The NASDAQ really taking it on the chin as well. Also down 2.3%. To me, what's interesting, though, David, is you're seeing kind of this risk-off sentiment across the board. A lot of selling, even in the commodity space. Really, to me, it's all a function of the dollar. Where's the dollar getting its kind of wind in the sails from? It's coming from the yields picture. The two-year yield got to, I think, 4.12 or 4.15 earlier in the session before turning around. And a lot of this, once again, is fueling the currency debate, now repricing how aggressively the Federal Reserve is going to have to go. And it's not just about the United States anymore. There's a lot of geopolitics, a lot of monetary policy across the Atlantic that's also driving flows right back into the States.
Okay, you led me there, the United Kingdom. I mean, you talk about some moves in bond yields. Wow.
I mean, this is a historic moment, really, to be watching. A 50 basis point move in the front end of the gilt curve, and I think 36 basis points in the 10-year gilt curve. Basically, all you need to know for our TV and radio audience here is this is monetary policy and fiscal policy butting heads at its finest. We actually have a headline on the Bloomberg terminal. Now you're seeing a 50% odds for a 125 basis point hike in November.
I couldn't quite believe it, actually. I saw that. I literally said, is that right?
That's how wild the pricing is. Remember, we're already at 100% odds for 100 basis points in November. That's kind of how much, for lack of a better term, the markets are freaking out.
So, gentlemen and ladies, place your bets. Okay, thanks so much to Kriti Gupta. You can catch Kriti again at 1 p.m. Eastern Time on Bloomberg Markets. Coming up, what the tightening financial markets mean for the housing industry with Selma Hepp of CoreLogic. That's coming up on Balance of Power, and we are on Bloomberg Television and on Bloomberg Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David West, and we want to keep you up to date with news from all around the world. For that, we turn to Mark Crumpton here with the first word.
David, thank you. Russia has begun staging votes on annexing the parts of Ukraine it still controls. The United Nations has condemned the votes, calling them, quote, a violation of the UN Charter and international law, end quote. Ukraine and its allies have denounced the referenda as illegal, and few countries are likely to recognize the results. In Iran, authorities are threatening to prosecute anyone engaged in what they call illegal gatherings following almost a week of deadly protests. They started last Friday after the death of a 22-year-old woman who had been detained by Iran's morality police for allegedly breaking Islamic dress codes. At least 17 people have died so far. After a summer of travel chaos with traffic jams on motorways and widespread disruption at airports, the threat of further shutdowns still looms over Britain's rail network. The latest transit strikes will coincide with the Tory party's annual conference, which runs from October 2nd to the 5th. Relations between bosses and unions have soured, with Conservative ministers also weighing in. Get ready to pay more for your Thanksgiving dinner this year. Turkeys are at record high prices, mostly due to an unexpected resurgence of bird flu sweeping across the United States. If just one bird gets it, its entire flock is culled in order to stop the spread. Millions of hens and turkeys have been killed in recent weeks. As a result, prices are nearly 30% higher than a year ago and 80% above pre-pandemic costs. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thank you so much, Mark. Well, markets all around the world are reacting to the tightening monetary policy, and that certainly includes the United States, where we see stocks down today. In fact, we're down now in the S&P 500 below that June low number, I understand. One of the markets that's being affected is housing. We heard from Fed Chair Jay Powell in his news conference this week saying there could well be a correction. And we talked just yesterday to French Hill, congressman from Arkansas. This is what he had to say about housing.
Inflation has driven up costs over the last 2 years in housing unbelievably. House prices are up about 19%. Rent is up. It's still driving this consumer price inflation. And so cost of building materials still remain high. Now, when you add this mortgage rate increase, yes, it's harder and less affordable for families. What I think we're going to see, David, is a slowdown in home construction, and we're going to see more innovative mortgage products.
We welcome now Selma Hepp of CoreLogic, where she is Deputy Chief Economist and the Executive of Research and Insight. And boy, we need some insight. Selma, thank you so much for being here. You really follow housing really closely. How bad is it?
Well, I don't think it's as bad as it may seem. You know, we are thinking about year 2021 and early months of 2022, when we were actually, in some sense, looking in the eyes of a bubble. And ever since mortgage rates surged and reached 6% in June of this year, we saw a quick reversal from those trends. So now we are just recovering from that sugar high that we had over the last couple of years. And naturally, you know, home sales have slowed. There are now about 14% lower year to date than they were in 2021. We are also seeing some deceleration in home price growth, and this is all good. You know, as I mentioned at the beginning of this year, first 3 months were some of the hottest months in terms of housing market competition that we saw historically. So to see some level of normalization in the market, to see more balance between buyers and sellers is in a lot of sense very, very good for the market. And it suggests that we will be having a potentially much healthier market going forward.
Yeah, that's really reassuring. So my natural question is, when is that healthier market going to come to pass? I mean, give us a sense about how these numbers work, whether it's home price sales, whether it's price of homes. How much is it a lagging indicator, a leading indicator? How much momentum is built into the system?
Well, in some sense, yeah, like you said, there is a lot of momentum built in, which is why home price growth reached its highest levels at the beginning of the year after all the buildup in year 2021. So it will naturally take a little while for this, at least according to our CoreLogic HPI, which is a repeat price index. It's a little bit different from the median sales index price, and so it does have a lot of momentum. And so, for example, in a median home price, you will already see some home price declines because we've seen pullback in luxury or higher price home sales activity. So that segment is taken out of the equation. So naturally, median home prices are declining or decelerating at a faster rate than that HPI that I was mentioning. But just to give you some sense of where we've been up until this point this year, home prices only in the first half of the year were up 10%. So even if we do see some home price decline over the next few months, we're still on par with where we were in 2021. And in all honesty, from the beginning of the pandemic until now, home prices have gone up 43%. So, you know, it's naturally, with mortgage rates being where they are, 300 basis points higher than at the beginning of the year, home prices up 20%. I mean, average consumer is looking at 50 to 60% higher mortgage payment today than they were even at just the beginning of this year.
Selma, give us your understanding of the relationship between home ownership, buying houses, and rental on the other hand. Because if fewer people are buying houses, then that would indicate to me more people have to rent. And rental has been one of the substantial contributors to inflation, has it not?
Oh, yes, it has indeed. We also do track rents in our single family rent index at CoreLogic, and rents have quadrupled as well in last couple of years compared to where they were prior to the pandemic. So in our most recent reading, rents were up 13%. And again, before the pandemic, they were up 4% on average. And so a lot of folks that can't afford to buy a home now are flocking into the rental market. But that was also happening during the pandemic, which is what drove rents up so much because people were migrating. A lot of this price appreciation and appreciation is simply a result of people's migration from more expensive coastal areas to more affordable areas in other parts of the country. And because they have higher budgets and presumably more cash because they sold those high-priced homes, and now they have more monies to work with and can bid up rents or prices higher.
And finally, Selma, give us a sense of the relationship between the federal funds rate, which is what the Fed is setting, and mortgage rates. I think I saw mortgage rates were up well over 6%, something like 6.29%. I'm not sure where they are today. If the Fed is going toward 4.5% or 5%, does that indicate where mortgage rates might end up?
Yeah, it was very interesting to hear the group express their interest in raising the rates much more substantially than was previously anticipated, which does mean much higher mortgage rates for consumers. Now, those two do move in tandem, but there's been an increase in mortgage rate spread, which means that mortgage rates have gone up much faster than the funds rate. And so that is a result of investors' fears of prepayments. If mortgage rates then in the future go down, there is a prepayment risk, and investors don't necessarily like that. And then there is a concern of unwinding of a mortgage balance from the Federal Reserve that's keeping that mortgage spread high. So at this point, I think we were expecting mortgage rates to remain or oscillate at the 5.5% average. I think with what happened yesterday, we may be looking more closer to 6%. Again, a much higher expense to consumers at this point with those higher mortgage rates.
Selma, this has been very helpful. Thank you for being here, Selma Hupp of CoreLogic. Coming up, Ukrainian forces continue to press the Russians in the east of the country as President Putin's mobilization efforts meet some resistance. We talk with retired Army Brigadier General Mark Kimmett next. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Ukrainian forces apparently have made some real progress in eastern Ukraine and the Donbass region, seem to be holding that territory, maybe continuing to press. In the meantime, President Putin came out this week and said we're going to have a partial mobilization and at least implicitly threatened nuclear weapons once more. To take us through what's going on in Ukraine right now, we welcome Mark Kimmett. He's retired Brigadier General who served as Assistant Secretary of State and also as Deputy Assistant Secretary of Defense under President George W. Bush. So, Mark, thanks so much for being back with us. Let's start first with this mobilization. I think they talked about 300,000. There are rumors maybe it's more than that. Assume we could get the 300,000. There seems to be some question about that. Is that going to make a big difference in the war? And if so, when?
Yeah, I think that's the right question. The good news, it's not going to be for a significant amount of time before those guys are actually combat capable. You've got to, first of all, bring them in. You've got to train them, you've got to deploy them, you've got to have them train with their maneuver units. So I don't think they will have an effect till early spring, if even at that point.
And what about training them up? Because there are some suggestions that perhaps the troops they have right now have not had the training that they need.
Yeah, well, remember, the 300,000 are all former military reservists. Now, true, they've been out of the military for quite some time, but they were probably trained to a relatively high degree in their past jobs. So that's why they really won't need training as much as retraining. And I would suspect that they're going to be pretty selective on who they bring in, and candidly pretty brutal for those that don't live up to their expectations.
Mark, I'm a little leery about some of the reports coming out of Russia because I don't know what's going on in there, but there are reports, you've seen some of the video actually, of a lot of people trying to leave the country so they don't get called up, particularly into Georgia, I believe, a lot of cars there jammed up on the border, and also some protests in Moscow. I can't evaluate how widespread that is, but is there a significant risk he couldn't get the 300,000?
I don't think so. Remember, they say they have the capability to bring in 25 million former military and men of military age. But even if it's a tenth of that, that's still a pretty good large amount of surplus that they could bring in. So 300,000, again, may not come soon, but I think he can get them.
Okay, when they do get them, I understand it may take a while to get in there, would adding that sort of level of troop really turn the tide?
I think it would certainly slow down what the Ukrainians have been able to accomplish over the last couple of weeks. I would think that, as I've said in a number of commentaries that I've written for the Wall Street Journal, I think we're going to get to a stalemate because for two reasons. Number one, that's a significant amount of troops. And number two, I'm not sure that we've been getting straightforward and correct information out of the Ukrainian military in terms of their losses, both in terms of people and equipment.
Yeah, it's that fog of war we read about all the time. So,
Yeah.
Mark, let me go to the other part that I at least heard in President Putin's remarks, and that was about if there was any attack on Russian territory, they would respond vigorously. A lot of people took that as being, yes, including possible nuclear weapons. And I tie that into some of the votes now, sham votes really, of annexation of some of the areas they've taken, which it strikes me that means that's Russian territory, I guess, according to President Putin. What is the real risk of maybe limited nuclear weapons being used?
Well, I'm glad you used that term, limited nuclear weapons. I think what they might use are tactical nuclear weapons, which have about 1/100th the yield of a weapon, intercontinental ballistic missile that they would use against us. It's part of Russian doctrine to use these. There is no difference between using conventional weapons and tactical nuclear weapons. But we all know that Putin is a little bit mad, but I don't think he's suicidal. If the West stands up, sort of what we saw with John F. Kennedy during the Cuban Missile Crisis, I think he'll back down from that threat. He may have a demonstration, but I don't think he'll use it inside of Ukraine.
So, Mark, let me ask the same question about the limited nuclear weapons, tactical nuclear weapons, as I did about the 300,000. If they did use them, would it make a huge difference on the battlefield?
No, not really. Those types of weapons are not military weapons. They're weapons of terror. I think they would use the threat of nuclear weapons and the actual employment of nuclear weapons to try to drive a wedge in the unity of NATO. Many of the countries just simply saying, we don't want to risk nuclear war to save Ukraine, not a NATO member. But practical military effects, we're seeing a lot more significant effects from the HIMARS missiles and some of the bomb strikes that have been going on.
Will we have advance warning as a practical matter if, in fact, they do use them? I guess from satellite and other intelligence, do they have to do some things to prepare to use those tactical nuclear weapons so we would know in advance?
No, I actually commanded units that had tactical nuclear weapons in them. The artillery rounds don't look any different whether they're conventional or nuclear. I don't know how they store them. If we know where all the storage sites, we may be able to see them pulling them out of their storage sites. But more than likely, we would be listening to their communications, electronic intercept rather than photographic evidence.
And tell about the weapons. You mentioned the HIMARS, the highly mobile, I guess, artillery that we've sent over that seem to be effective. The Ukrainians say they need more. But is it more of what they've got, or is it something different altogether? Because they're talking about very sophisticated tanks, for example, and also, as I understand, longer-range missile systems.
Yeah, I think the latter issue, the longer-range missile systems, is what they really want, and that's what NATO is most concerned about for the points you made earlier, which is that would give them the capability to strike into Russian territory. And that has been a red line for NATO at this point, which is there will be no use of weapons supplied by NATO on Russian territory because of the potential spillover effects. Giving them the longer-range ATACMS missiles, as we call them, wouldn't have a significant practical military effect on the ground in Ukraine, but it would be able to attack those supply sites that the Russians are now putting in Russia rather than in Ukraine. But then you've attacked Mother Russia with the consequences from that.
So, Mark, I've asked you this before in a different context with respect to Ukraine. I'll ask it again. Whose side is time on right now? There was a time that was thought that it was on the Russian side. Is it still, particularly if, in fact, Ukraine can hold out and hold some of the gains that they've had through the winter, does Russia's bargaining position actually go down, particularly with respect to energy into Western Europe?
Well, I actually think what the Russians are hoping to do is hang on to what they have. They believe that through a tough winter, the European unity may not hold. But I also don't believe that despite the reports we may be seeing in the media, I really don't think the Ukrainians are as strong as we might think they are. Their counteroffensives have slowed down, possibly stalled. if Russia is serious about hanging on to that terrain, I think we'll see us back to the 2014 lines, the Minsk agreement lines, and we find ourselves in a stalemate with both sides looking at each other and using a heck of a lot of artillery on a day-to-day basis. But I don't see the Ukrainians getting back to Mariupol, and this notion that somehow they will take over Crimea again, I think it's fanciful.
Mark, it's always good to talk to you because it's so very helpful. I really learn something every single time. That's Mark Kimmett. He's a retired brigadier general. Coming up, the S&P 500 is erasing all gains since the stock sell-off back in June. We're going to bring you the latest next as markets face a sea of red. This is Balance of Power on Bloomberg Television and on radio.